Hi, good morning. Welcome to Morning Kappa. Here we come to the week 3 of May with futures. Before we begin, I would like to highlight a brief disclaimer. Trading in futures and options involve a high level of risk due to leverage and may not be suitable for all investors. This presentation is intended for educational and informational purpose only and does not consist of any invitation or recommendation to buy or sell any financial instrument. Please consult your licensed broker or financial advisor before making any trading decision. Okay, let's start with the global market has shifted into a neutral stand this week as investors responded cautiously to President Donald Trump's remark hinting at possible progress towards a peace agreement with Iran. Despite the comment, market participants remain doubtful that a resolution to the crisis is close. As a result, investors have adopted a cautious wait-and-see approach, focusing on the upcoming release of the latest FOMC minutes and flash US PMI data for further guidance on monetary policy and economic activity. In the US market, the Nasdaq 100 and S&P 500 and Nikkei 225 have transitioned into neutral trading profile, signaling at the short-term bullish run has paused for a healthy technical correction. In Asia, the Hang Seng and China A50 has shifted into neutral. The initial momentum driven by strong Chinese factory and economic data has leveled off as regional investors adopt a cautious stand while awaiting concrete updates on global trade and shipping routes. Gold and copper have shifted to neutral. Silver experienced a sharp reversal, moving from a positive profile to a negative bias this week, confirming that buyers are stepping back to elevated levels. And crude oil has remained in a neutral profile for a consecutive weeks. However, due to physical reality of ongoing shipping blockades, its long-term overall trend remained firmly positive. Natural gas continues to hold a neutral profile. Crude palm oil has improved this week back to 4,600 level yesterday. For corn and soybean, both remain in neutral as high global supply balance out cost pressure. Next, the one that's on our radar is gold. Recently, gold slipped below USD 4,550, giving back part of the previous session gain as uncertainty surrounding the Middle East conflict and persistent inflation concern weigh on sentiment. While gold has remained under pressure since the conflict erupted. With soaring oil prices fueling inflation fear and reinforcing expectation of additional central bank interest rate hikes. At present, gold has been consolidating within the price range of 4540 to 4867 over the past few weeks and is currently attempting to break below 4540 level. The next support level is monitored at 4431. The next product that's on our radar is crude oil. WTI crude oil futures remain rebounded from USD 99 per barrel as tentative US-Iran ceasefire talk keeps supply risks elevated, particularly around the Strait of Hormuz. Investors remain cautious, balancing geopolitical uncertainty with upcoming economic data that may reveal the outlook of a monetary policy and economic activity. As a result, prices are currently retesting the key level of 107. If this level is breached, the next resistance to monitor is 111. Before we look ahead, let's audit last week. Unfortunately, we have two calls with realized loss. Micro gold, the price has reached our potential loss price with a realized loss of USD 300. The second call was micro Bitcoin. The price has reached our potential loss price, resulting in a realized loss of USD 160. As usual, the highlight of our briefing, the future market call. Building on last week's momentum, we are anticipating potential opportunity in micro copper. The initial investment is USD 1,320. Short-term chart setup is positive, and reference enterprise is 6.11. Potential profit target is 6.5565, targeting gain of 1,116. Potential stop loss price is below 5.95, capping the loss at 400. The next call is soybean oil. The initial investment is USD 2,310. Short-term chart setup is negative, and reference price is 75.25. This is a stop where it's a stop order. Potential profit price is 73.15, targeting a gain of USD 1,260. Potential stop loss is above 76.1, capping the potential loss at 510. The risk and reward ratio to near 1 to 2.5. If you like what we have shared, there's never been a better time to start. If you are new to futures, we have a TWP 2.0 booster reward campaign to start your futures trading journey with zero brokerage up to 1,000. This is only from 13 May to 12 June. Reach out to us and drop us an inquiry through the RHB TradeSmart website to get started. And every trade that you place will also automatically qualify you for trade and win lucky draw entries, giving you chances to win a Tesla, take away the monthly prices of iPhone 17. We are delighted to invite you to our exclusive physical event entitled Futures Insights on Saturday, on the 20th of June in Penang Bayview Hotel, where three special guest speakers, Daniel Ng from CME Group, Joseph from RHB Research, Retail Research, and myself will share insights on market trend, trading opportunity, and strategies to help you navigate today's dynamic environment. Don't miss out. That's all from me today. Thank you for your time, and I will hand over to the next speaker. Thank you. Have a good day.
All right. Thanks, Meagan. Okay, morning everyone. Welcome back. Welcome back. Okay, so looking at the S&P 500, well, it fell around 0.767% on Tuesday's session, right? With sentiment turning weaker after the recent record high um, uh, trend recently, right? So the sell-off was mainly triggered by a sharp rise in the U.S. Treasury yield or the bond yield after stronger than expected economic data reduced the expectation for the near-term Fed rate cut. So yeah, higher yields pressure the attack and also growth stocks during the session. So theoretically, the hit from the higher expectation of interest rates are still there. Um, also at the same time, I think investors also turn cautious ahead of several key earnings releases, right? With some concern that valuation are becoming stretched after the recent rally. So I believe the energy stocks also came under pressure following the volatility in the oil prices, adding to the broader market weakness. Um, And looking at the China A50 futures, well, it closed slightly lower on Tuesday session with sentiment turning cautious after the recent rebound. I think the weakness was mainly driven by the profit taking in the cap, uh, large cap tech, and also the financial stocks as investors lock in gains near recent high. And the sentiment was also pressured by lingering concern over China economic recovery, especially with the weak consumer spending and also property sector uncertainty still weighing on the confidence. Well, also not to forget, I think all eyes are focusing on the Russia-China meeting recently, right? Just right after Trump's visit to China. Um, so I think this meeting would likely to benefit both giants targeting the trade and also the energy discussion. I think the bearish tone um game as investors stay cautious ahead of the potential developments surrounding the US-China trade relation, also the policy direction as well. Um, right. So looking at our Malaysia market, our local market, right? The FBM KLCI closed slightly lower by around 0.03%, while the FKLI marginally higher, about 0.09%, showing a relative mix. But to me, I think it's a stable session for yesterday as a overall, right? So the softer MKL's performance was mainly due to the more profit taking in selected heavyweight stocks as the market lacked fresh local catalysts as we head into the second half of the 2026. However, I think the FKLI managed to stay positive as sentiment improved slightly following the um, slightly firmer US market and continued strength in the global tech related stocks. Also, at the same time, I think investors are monitoring the developments surrounding the global trade discussion and also the interest rate expectation as well, which kept the broader market participation cautious, right? So coming into the next session, I think the market is expected to remain sideways with selective buying interest. So yeah, just to mention, um I mean the foreign funds, right, also extended their selling continuous selling streak, right, marking the I think around fifth consecutive sessions of the net outflows as the external macro uncertainties triggered the ongoing portfolio uh I would say portfolio reallocation. However, the downside was partially cushioned by the selective retail buying on the stronger than expected first quarter corporate earnings as well. So I believe that the analysts expect the market to remain selective in the near term, uh, in near future, at least, until clearer sign emerge from the global macro environment. So yeah, I think for now, the FKLI's resilience suggests traders are cautiously positioned for the near-term stability despite the softer um, KLCI market, right? So yeah, look at the heat map. I think SCI continue to mix, right? From the profit taking in the selective tech and also the consumer related counters weighing on the broader market, I think. But yeah, notable weakness seen in the Obsta and also MKH as of yesterday. However, losses were partially cushioned by gains in utilities and also transportation stocks or sector such as Soil and also Westport, while selective buying in construction names help to keep overall sentiment relatively stable. Well, at least for now, right? Yeah, looking at our Malaysia trading stocks, so today we have 99 Speedmart retail, right? So the stock is on its breakout formation, high at trading and 40 cent level on a strong volume. So with that, we expect the momentum to keep bullish and the stock able to propel to test the next resistance at trading at 60 cent, followed by trading at 80 cent level. So if the stock to clear the trading at 20 cent support, this could reverse the course and trend lower. And also next we have Mega First Corporation or FCB, right? So the stock experiencing a pending breakout formation at trading at 15 cent level. So if the stock remains bullish, we expect the price to reach trading at 30 cent in the coming session with high volume as well. Second resistance is at 345 cent level. Do keep an eye at the 3 ringgit support for any attempt of reversal. So today we have one breakout stocks and also one pending breakout stocks, which is MFCB or Mega First Corporation. And lastly, looking at the FCPO, well, it rebounded strongly by around 1.17% on yesterday's session, despite our overall near-term, I would say, negative bias remaining intact, right? So the rebound was mainly supported by stronger those soybean and also grower prices, which improve sentiment across the oil market. Also, at the same time, I think the bargain hunting emerged recently after the sharp sell-off, right, with traders buying back position as prices look technically oversold near the 439 support level. But however, we still keep our negative trading bias unchanged unless the commodity to cross higher above 4,700 level, which could change the sentiment, right? But for now, we still keep our negative trading bias unchanged. Targeting for the 4,390 as well as 4,300 level. Right. So that's all from me, and I pass the floor to Sian for her economic update. Thanks, everyone, and happy trading.
Thanks, Aiman. So, good morning, everyone. A quick update on our recent revision in our 2026 in-house inflation forecast, and also April CPI data, which was released on yesterday. So, recently, actually, it's yesterday, we have revised our 2026 headline inflation forecast upward to 2.1% from our previous projection of 1.8%. So our recent revision in the inflation is still in line with the official projected range of 1.1 up to 2.5%. So the upward revision to 2.1% is predicated on two key reasons. So firstly, elevated crude oil prices, as the crude oil prices is still stay above $100 per barrel. Second, the revision in the Budi 95 subsidized petrol monthly quota. So both of which are expected to contribute to higher transportation costs and is already evident in the latest inflation print. So meanwhile, persistently elevated crude oil prices might lead to broader spillover effects on domestic production costs, as what we see in the recent PPI print and consumer prices going forward. On year-to-date basis, inflation has increased by 1.7% for the first 4 months of the year, so versus pre-conflict average, which is the January and February average level of 1.5%. So for the April itself, the April CPI actually came in at 1.9% on year-on-year basis, so versus March print of 1.7%, marginally lower than our in-house projection of 2% and in line with the Bloomberg consensus estimate. So meanwhile, the core inflation posted 2% year-on-year in the as well. So signaling there are still persistent underlying price pressure and resilient domestic demand. So we also see that on a 3-month moving average basis, the headline inflation momentum has actually trended higher for the month of April, while the core inflation momentum stay flattish as well, stay flattish. So across the basket, so the group of transport actually has inflation for the group of transport has actually gained pace to 4.1% year-on-year in April versus March print of 1.6%. So due to higher expenditure in the subgroups of public transport services and also operation of personal transport equipment amid a higher fuel cost. We haven't noticed any significant upsides in other components of the CPI basket yet for the April print, with the food and non-alcoholic beverage group so inch higher to slight inch higher but stay manageable at 1.2% compared to 1.1% in March. So and then lastly, cost in the housing, water, electricity, gas and other fuel category inch lower to 1.1% in April versus March print of 1.2%. So moving forward, so we do see the cost push pressure warrant close monitoring as higher oil prices could feed through logistics, utilities and broader production costs with potential spillover to consumer prices. However, the impact is also cushioned by the continuation of fuel subsidies for eligible groups as well. So and then 3 key factors will actually continue to drive the inflation in the upcoming months, so including the fluctuation in global commodity prices, any changes in the domestic policies, and also still there is a demand-led inflationary pressure due to domestic growth momentum staying resilient at this juncture. So amid a lingering global uncertainty and commodity price volatility, cost post-inflation risks do warrant monitoring in the months ahead. And the impact of ongoing middle geopolitical tensions on Malaysia will depend on duration and severity of the conflict, and also the extent of disruptions to global energy supplies as well. So, and then over the longer term, so we do see that aside from the impact from the oil prices, so producer prices or which we use as a proxy for business and manufacturer costs will remain a key driver for consumer inflation as well. So producer level cost pressure are beginning to build across both the goods and services sector as per the latest print. So for example, the PPI for local production rose by 1.1% year-on-year in March, so ending a 12-month decline, while the services PPI also has accelerated by 2.1% in the first quarter versus 1% in fourth quarter last year. So rising price pressure will observe across key sectors, including manufacturing, agriculture, utilities, and transportation services. So secondly, changes in domestic policies. While we do see that the recent reduction in the Budi 95 targeted subsidy cap to 200 liters per month will have limited upside, will have a manageable upside on the inflation. For full year is around 0.25 up to 0.3, so which we have already taken into consideration in our latest revision of the CPI forecast as well. So, and then lastly is demand-driven inflation pressure. So due to domestic growth momentum are still staying resilient for now. So we expect OPR to remain unchanged at 2.75% for the full year. So where monetary policy will still likely to remain data dependent, with decision based on economic growth prospect and underlying inflation momentum. So however, if the inflation turns out to be higher and more volatile than expected, for example, higher than upper bound of official forecast of 2.5%, a rate hike cannot be completely ruled out. So particularly against the backdrop of still a robust economic prospect as what we see now. So that's all for me. I'll pass the stage to the next presenter. Thank you.
Hi, morning all. Thank you, Sian. Let me continue with result review note on Samaiden. So 9-month core Patami up 86% year-on-year to 24 million, beat our and consensus full year estimate at 79% and 81% respectively. The positive deviation was mainly driven by a stronger than expected net margin of 9.4% as compared to last year's 6%. So as of third quarter, Samaiden outstanding order book is close to 500 million, with year-to-date project wins of 400 to 500 million, versus our order book replenishment assumption of 600 million. And notably, the 2 gigawatt LSX6 tender with an expected value of close to 10 billion ringgit after the inclusion of battery may only be called in the second half of this year, versus the earlier guidance of second quarter. And this is mainly driven by the market uncertainties arising from the Middle East conflict. All in, we raised our earnings estimate for the next 3 years by 6 to 13% after raising our GP margin assumption. We maintain our buy call for now with a new target price of 1 ringgit 84 cents from 1 ringgit 70 cents previously. And we continue to like the stock as it is one of the beneficiaries of the rising electricity bills. And we see this as a fresh catalyst to drive solar adoption on top of governmentally initiative to achieve net zero by 2050. And last but not least, in terms of the valuation, Samaiden Group is still trading at -1 standard deviation at 16 times. That's all from me. Thank you for listening and see you again tomorrow at Morning Kappa. Happy trading, everyone.